Most investors have never lived through a real bear market. They think a 10% dip is a crash. But what if I told you that the game is about to change and the next phase of the stock market might look nothing like the last 15 years? It's happened many times before, and they call it a lost decade. Today, I'm going to show you what it is and why Buffett keeps warning about it and how to win while others lose their nerve and give up. Guys, even in 2020, during the COVID crash, we had 1 month where we lost almost 40%. And guess what? The year ended up in the positive still. So even then, when the world shut down, people weren't even spending money, the world ended up with a higher stock market. Now, I want you to meet Tom. In 1999, Tom retired early. He wasn't a trader. He wasn't flashy, just smart, practical. He worked hard. He invested consistently, and the market had rewarded him. Tech stocks had made him rich. Microsoft, Cisco, Intel, all the names everyone knew. His account had doubled in just a few years. His financial advisor told him, 1, you're welcome, and 2, he was all set. Early retirement was not only possible, it was smart. Tom believed it, and why wouldn't he? The economy was booming. The internet was changing everything. The NASDAQ was hitting new highs every day, every week, every month. Owning stocks didn't feel risky anymore. It felt responsible. So Tom made a choice. He went all in. He sold all his rental properties. He rolled his 401k into a growth-heavy portfolio. He bought more tech, more S&P. Why not? It was working. And then, nothing. From 2000 to 2010, the market flatlined. The dot-com crash hit. Then came 9/11, then Enron, then the housing bubble, then the great financial crisis. The stock market would eventually recover, but would take over a decade to get back to new highs. Tom's account balance hovered around the same number for years. In fact, he was also pulling money out of these investments because he was retired. But guess what? Groceries got more expensive, property taxes went up, healthcare premiums climbed. He didn't feel like he was losing, but he was. By 2010, Tom's portfolio had lost over 25% after inflation-adjusted dollars. Not because he panicked, not because he sold, but because he believed he was safe. Guys, this is something I always hear. Markets always go up. Let that phrase sink in. That is very commonly an illusion that occurs during big bull markets. So not only did the crash hurt Tom because he lost a big chunk of his money, but he retired because he thought markets were going to continue to go up. So he was pulling money every single month as stocks were crashing. He thought that being in the market meant safety, but he was a real kicker. Tom did everything right according to the playbook he was given, and still he lost. Now fast forward to today. It's 2025. Interest rates are much higher than they were in the last 15 years. Inflation isn't going away. Tech is hot again. Everyone's talking about AI, crypto, electric vehicles, and you've been told over and over again that you're smart if you buy the dip, that it always comes back. The stock market always ends up higher. And that's been true in history, depending on your time frame. Here's the problem though. What if you're Tom? Even if you're not Tom today, you will be Tom someday where you're close to retirement. Guys, this isn't hypothetical. Most investors today have only known one kind of market, the post-2000 bull run. And therefore, you're probably not like Tom where you're retiring early or quick, but you've only experienced a bull market. You lived through one bear market, 2020, and it lasted 4 weeks. Then the Fed dropped rates, printed money again, stocks exploded, ended the year in the positive after the world shut down. If you couldn't even lose when the world shut down, how are you ever going to lose? That would be a normal thing to think. Between 2009 and 2021, the S&P has given people over 500% return. Apple, Amazon, Tesla, Nvidia, everything went up, and it went up steadily and then started to speed up. Guys, the issue we have is this, and this is something that people have a hard time understanding. Easy money equals bad habits. Easy come, easy go. That's the danger. Because when everything is going up, you stop asking why. When everything goes up, you stop worrying about, hey, what does the future hold? Should I be more cautious? You stop thinking about value. You stop calculating what something is actually worth, and you just assume it's early, it's innovation. It always comes back. That's what a strong bull market trains people to believe. But belief is not a strategy. And cycles don't care what you believe, and stock prices don't care what you believe. See, markets don't move in straight lines, guys. They move in cycles. Valuations expand, they contract, risk is ignored, liquidity flows in and out. What I mean by that is money goes into stocks, money comes out of stocks. The real issue with the great financial crisis was that banks just stopped lending on certain assets, and that's what makes prices plummet. And when money is going into assets, returns accelerate. Bitcoin. As more money goes into Bitcoin, what's going to happen to the price? Until they don't. Then you get the slow part, the grind, the fatigue, where prices go sideways, where companies still grow, but stock prices don't. But most people don't pay attention to the fundamentals of the business. They care about the stock price. That's why you're smart for being here. So guys, let's fast forward to 2027. You log into your brokerage account. Your balance hasn't moved much in 3 years. You've been buying the dip. You've stayed disciplined, but it stopped working. Meanwhile, your friend just flipped a house and made $200,000. Another buddy doubled their money on some random crypto token. Your coworker's selling online courses and driving a Tesla Cybertruck. And you're flat. You're not down, you're not up, you're just stuck. That's what a lost decade feels like. It doesn't make you panic. It makes you question the decisions that you have made. And once that doubt starts to creep in, if you don't understand what you're buying, you're going to start wondering, is this even worth it? And that's when most people quit. Look at Amazon and Tesla. These are two companies that are phenomenal, that its revenue and profits have skyrocketed in the last 3 or 4 years. But here are their charts over the last 3 or 4 years. A lot of sideways movement. Now, you might still sit there and be big believers in these companies, but eventually, if the price goes sideways or down for too long, you're gonna start questioning. We had someone in our community who was the big Tesla bull, and he said, I will never sell my Tesla. Fast forward a few years, sideways movement, guess what he did? He sold his Tesla. And of course he gave himself a story. I'm not selling because of blah, 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 because the Tesla stock went nowhere. Okay, because the fundamentals said it got better. They don't sell because they fear loss. They sell because they lose belief. This is the setup. This is where the story begins. Because what's coming next isn't about prediction, it's about preparation. The real risk isn't a crash. It's a decade of nothing, where patience is punished, where discipline looks dumb, where the crowd gives up, not all at once, but slowly and silently. And those who understand what's happening, they'll be the ones ready when it turns. Now, before we go further, let's define what is a lost decade, because this isn't just a term that people and economists throw around. A lost decade isn't a market crash. Now, there may be some crashes or bear markets within it, and there may not necessarily be a recession. And it's not when the S&P drops 40% overnight. A lost decade is worse. It's when you're still invested, you're still contributing, you're still doing all the right things you were taught to do. But yet 10 years later, you have nothing to really show for it besides the money you added. Now, let's look at 3 examples here. Japan's a big one. In 1989, the Nikkei 225 hit nearly 40,000. Tokyo real estate was worth more than all of California. Investors believed that Japan had cracked the code. Exports, engineering, efficiency, everyone was all in. And then it stopped. Over the next 20 years, the Nikkei dropped well under 10,000. An entire generation lost faith in the stock market. People called it the lost 2 decades. And guys, what's even crazier is, it's been over 30 years since 1989, and just recently did the Nikkei finally break that all-time high from 1989. Okay, what about US? Because the US is a lot different economy than Japan. Japan has some economic issues and even demographic issues, but the US, we don't have that problem. But from 2000 to 2013, if you were an investor in the S&P, you were riding high to start. Dot-com fever had taken over, valuations were stretched, but everyone believed this was a new economy. It was going to be different this time. The market peaked in 2000, in March of 2000, and then the unraveling began. The dot-com bust started. Fast forward a year and a half later, 9/11, then Enron, then WorldCom, then Tyco. Then, a few years later, a housing bubble, financial collapse. But guys, guess what? The housing bubble was probably started because of the crash. People were saying, I'm not getting any money out of this. Let me go invest in something else. Couple that with loose lending standards and lower interest rates, and you have a bubble forming. Then we had the collapse. It wasn't until 2013, 13 years later, the S&P 500 finally made new highs. That entire time, the index was up and down, but there were moments of hope in there. That's a lost decade. And the biggest lost decade, guys, Third example, 1970s. We came off a major bull market in the 60s. In fact, it was so strong that Warren Buffett didn't see things to buy, so he ended his partnership and distributed the money back to everybody saying, listen, I can't find anything, and he didn't want to hurt his historical returns. Guys, the 1970s weren't defined by collapsing prices. They were defined by rising prices. You had stagflation. The US economy wasn't growing. We had inflation. We had an oil issue. We had huge inflation that led to high interest rates. The S&P in 1966 was around 110. In August of 1982, it was at 110. That is 16 years. And guys, that's not a one-time occurrence. Now, guys, I'm not trying to put fear, uncertainty, and doubt in people's minds. What I'm trying to remind people is, be ready for flat prices for a while. Be ready for volatility. It's okay. It will be your friend and you'll come out better. Because look what happened from 2013 to now. Yes, if you were patient from 2013, it felt a little like, what's going on here? But that payoff came through from 2013 to today. Your job is to continue buying. And you might be wondering, well, okay, great, but Warren Buffett always tells me dollar cost average. Don't ever stop doing that. But I also want you to look at what Warren Buffett does with his own money. Warren Buffett's Berkshire Hathaway cash keeps on growing, and it's at $350 billion today. What he's saying here is, there's not much stuff that's big that I can buy. And guess what? When you buy the S&P 500, you're buying big companies. There will be a time when markets fall and he starts deploying this cash. And when that happens, that'll be a start of an indication that maybe things are getting better. Now, guys, being able to stomach this is the most important part. Yes, we can learn the numbers all day long, but if we don't understand the emotional part of things, of why things are falling, you'll never be able to implement the things you learn about the numbers. This is why I have my principle-driven investing approach to life and investing. It's not about numbers. It's about ways of thinking about things when it comes to money. So if you want to have these 5 tenets that are very important to be a successful emotional investor, please click the link below, absolutely free. It'll be emailed to you within 1 minute. And most importantly, how much I believe in value over hype. We all know the Magnificent Seven exists. It's been what's keeping the market up for a long time. Well, at the start of 2025, I created my own Magnificent Seven of 7 stocks that I owned that were boring, not hype stocks. And I said, these will beat the market and beat the Magnificent Seven over the long run. And so far, the results are surprisingly great. I didn't think it was going to do this well this soon, but also, it's only been 6 months, so I'm not declaring victory yet. I want to watch these things for years because that's what I truly believe in. The short run does not tell me if I'm right or wrong. It's the long run that will. So I want you to do me a favor, watch this next video on your screen where I go through my own Magnificent Seven and how they compare to the other Magnificent Seven. Thank you for your time.